You've probably seen the headlines by now. Venezuela's hidden gold exposed. A 161-ton seizure that could change global markets. Some channels are already jumping to conclusions about sanctions collapsing, gold exploding overnight, or the dollar losing credibility in a single news cycle. Today, I want to slow this down, strip out the noise, and walk through what actually happened, what the data really says, and what it likely means going forward. This is Financial Briefing, and my goal here isn't to sell you a narrative, it's to give you clarity, probabilities, and a framework you can actually use. Before we dive into Venezuela and the gold seizure itself, I want to ground this conversation in accountability. Back in March, when gold was trading around $150 an ounce, we said the risk-reward was skewed toward consolidation rather than a straight breakout. Gold went on to chop sideways for nearly 6 weeks before resuming its move higher. In early May, when silver briefly touched $34, we said odds favored a pullback into the high 20s rather than an immediate run to 40. Silver retraced to just under 29 before stabilizing. And in June, when yields spiked above 4.6% on the 10-year, we said that was more likely a temporary overshoot than a regime change. Yields have since settled back closer to 4.3. Not perfect calls, but transparent ones. That context matters as we talk about something as emotionally charged as sovereign gold seizures. So let's get into the substance. The first data point is the headline number itself. Approximately 161 metric tons of Venezuelan gold reportedly seized or frozen through coordinated international actions over multiple years. To put that in context, Venezuela's official gold reserves at their peak were around 360 tons in 2011. This means we're talking about roughly 45% of what was once the country's reported reserves. That sounds enormous, and in relative terms it is. But in absolute global terms, 161 tons is about 0.08% of total above-ground gold supply worldwide, which is estimated at roughly 205,000 tons. What it means is that this is geopolitically significant for Venezuela and symbolically important for how gold is treated under sanctions regimes. What it doesn't mean is that this suddenly constrains global gold supply or mechanically forces prices higher. The second data point is where that gold was and wasn't. A large portion of Venezuela's gold was historically held abroad, most notably in the Bank of England. Around 31 tons became the subject of a high-profile legal dispute beginning in 2018. Other shipments were intercepted or frozen through sanctions. Enforcement tied to illicit gold exports routed through Turkey, the UAE, and parts of Africa. Historically, this mirrors how sanctioned states have tried to monetize gold when cut off from dollar funding. What it means is that physical gold held outside a country's borders is not politically neutral. Custodial risk is real. What it doesn't mean is that every country holding gold abroad is about to lose it. Venezuela is a special case, with disputed governance, sanctions, and legal rulings recognizing an opposition authority at the time. The third data point is timing. These seizures and freezes did not happen all at once. They accumulated over roughly 6 years, from 2018 through 2024. During that same period, gold prices rose from around $1,200 an ounce to over $2,300 at recent highs. If this seizure were a dominant driver, we would expect a sharper, more synchronized market reaction tied directly to enforcement actions. We didn't see that. What it means is the market has largely absorbed this information incrementally. What it doesn't mean is that gold is suddenly repricing sovereign risk overnight because of one headline. Now, let's fairly lay out the bullish case because there is one. First, this reinforces the idea that gold held domestically is fundamentally different from gold held abroad. For countries already skeptical of Western custodians, this accelerates repatriation and reserve diversification. Second, it underscores that gold remains a sanctions-resistant asset only if you control it physically, which increases demand for physical custody and storage outside traditional financial hubs. Third, it adds to the broader narrative of de-dollarization at the margins, particularly among countries already on the geopolitical periphery. And fourth, it feeds long-term central bank demand, which has averaged over 1,000 tons per year since 2022. If these dynamics compound, gold could sustain a higher floor. I'd assign a 25% probability to this bullish path materially influencing gold prices over the next 12 to 24 months. But there's also a strong bear case that needs to be acknowledged. First, Venezuela is not representative. Most central banks operate within the international legal framework and are not under sanctions. Second, the gold in question was already economically impaired. Markets were not pricing it as freely tradable supply. Third, gold's recent price strength has been driven more by real yields, inflation expectations, and central bank buying than by seizure risk. And fourth, headlines like this tend to have a short half-life. Attention moves on quickly unless reinforced by new actions. In this scenario, the story fades without lasting market impact. I'd put the probability of this outcome at around 30%, which brings us to the middle case, and this is where I land. The most likely outcome is that this event becomes another data point reinforcing existing trends rather than creating a new one. Central banks already inclined to repatriate gold continue doing so gradually. Investors already holding gold feel validated but not compelled to dramatically increase exposure. Markets digest the story, file it under geopolitical risk, and move on. Gold remains supported, but not because of Venezuela specifically. I see this as the base case with roughly a 45% probability. To understand why, it helps to zoom out historically. A useful comparison is Libya in 2011. Libya held around 143 tons of gold when sanctions were imposed during the civil war. Those reserves were effectively frozen and became unusable to the regime. Similarity: sanctioned state, contested governance, gold rendered inaccessible. Difference: global gold markets barely reacted. Prices were driven instead by the Eurozone crisis and US monetary policy. The lesson is that sovereign gold seizures matter a lot to the country involved, but far less to the global pricing mechanism unless they trigger broader systemic change. Now let's check the cross-market signals. Gold is currently trading around $2,300 an ounce, consolidating after a strong run. The dollar index is hovering near 104, not collapsing, but not breaking higher either. The 10-year Treasury yield sits around 4.3%, off recent highs but still historically elevated. This combination tells me the gold market is being supported more by long-term hedging demand than by acute fear. If this seizure were a systemic shock, we'd expect a sharper dollar sell-off and a more aggressive bid in gold. We're not seeing that. Positioning data supports that view. The latest COT reports show managed money net long gold, but not at extreme levels. Commercial hedgers remain balanced. Banks are not heavily skewed toward a runaway upside scenario. Institutional behavior looks cautious but constructive. This is not panic positioning, it's measured exposure. So here's my personal action plan, and as always, this is not advice, just my framework. If gold breaks and holds above 2,450 with real yields falling below 1.5%, I increase allocation modestly. If gold fails and drops below 2,150, I reduce exposure and weight. Currently, I'm allocated roughly 12% to gold, 4% to silver, and the rest diversified across equities, cash, and bonds. My stop loss on incremental gold positions sits around 2,100. My take profit on tactical trades is near 2,500, with a core position held longer term. Equally important is what I'm not doing. I'm not panic buying because of one geopolitical headline. I'm not binge watching fear-based content predicting imminent financial collapse. And I'm not assuming that every sovereign action signals the end of the current monetary system. For this week, my watch list is simple. First, any official commentary from major central banks on reserve management. Bullish if it signals increased gold purchases, neutral if silent. Second, movements in real yields. Bullish if they trend lower, bearish if they spike. Third, price behavior around 2,350 in gold. Acceptance above is constructive. Rejection suggests consolidation. To wrap this up, here are the key takeaways. 1. The Venezuela gold seizure is significant politically, not systemically. 2. It reinforces existing trends rather than creating new ones. 3. Markets are reacting calmly, and that matters. And 4. Disciplined frameworks beat. Emotional reactions every time. If this kind of calm, data-driven analysis helps you think more clearly, consider subscribing. This is Financial Briefing. Thanks for spending your time here. Stay sharp.